Index fund, mutual fund, ETF. Don't they all sound very similar? Which one holds the key to financial success? It's time to unravel the mystery and settle this debate once for all. By the end of this video, you'll have a clear understanding of how they differ and which one might be the best fit for you. And I also promise that you will have some fun along the way. So let's begin with mutual fund. Alright, let's dive into the world of mutual funds. These bad boys have been around for ages, long before index funds or ETFs decided to join the party. We are really talking ancient times, like way back in 1800s. They were created so that a bunch of folks could join together, pull in their money, and then invest together. Pretty simple, right? It's like they decided to create a financial Avengers team, of course, without the capes and the superpowers. There are some clear benefits of mutual funds. So picture this. Imagine you want to own 100 different stocks in your portfolio. Without mutual funds, you may have to do 100 different purchases. That may mean clicking the buy button 100 times and even paying trading commissions so many times. Talk about a serious case of finger fatigue. But fear not, my friend. With mutual funds, you can buy all those stocks in a single purchase. It's like shopping for stocks all over with a single checkout window. Super convenient, right? We have all heard the saying, don't put all your eggs in one basket. With mutual funds, you won't have to. Diversification is the name of the game here. Instead of putting your entire fortune on one stock and then hoping for the best, mutual fund lets you spread your investment across different stocks. That way, if one stock crashes and burns, you won't cry over your basket of broken eggs. Your portfolio stays largely intact thanks to the power of diversification. So who need to be the stock picking genius when you can have your money managed by professionals? With mutual funds, you get your own team of investment wizards. These folks are like Professor Dumbledore of finance, of course minus the beard and the magic wand. They spend their days analyzing stock, making smart investment decisions, and trying not to spill coffee on their keyboards. By investing in mutual funds, you get access to their expertise without really lifting a finger. But it's not all good. There are some distinct drawbacks with a mutual fund. Yes, now let's talk about the not so fun part, fees. We're all familiar with that friend who always seems to have a handout, asking for some slice of the pie. Well, in the mutual fund world, that friend is the fund manager. These brainy individuals charge you a fee, typically based on the balance of your mutual fund. That is the amount that they manage. So even if the investments go south, your overall investment suffers and you suffer a loss, they do get their cut. It's almost like paying the personal trainer, even if they make you gain weight instead of losing weight. Not cool, right? Here's the thing about fund managers. They may have some good years where they hit it out of the park. But like the one-hit wonders in the music industry, their performance and their success may not last. And of course, we can't forget about those fees. Over time, those little fees can take a big chunk out of your hard-earned money. We are talking about hundreds of thousands of dollars gone in the wind over a lifetime of investments. So while some mutual fund may sound like a hot deal based on recent performance, make sure you look at their long-term cost and fees and not let those rain on your financial parade. For a long time, there was no alternative to mutual funds. But then came along Jack Bogle. He was a man who became fed up with the exploitative practices of the traditional mutual fund industry. He then came up with a groundbreaking solution called index funds. Index funds completely revolutionize the landscape of investing. Unlike traditional mutual funds, index funds are passively managed. That simply means that instead of paying an expensive fund manager to actively make investments decision about buying and selling, an index funds follows a predetermined formula for buying and selling assets that eliminates any need of human intervention. But why are they called index funds? To understand index funds, important to know what an index is. An index serves as a representative sample of the entire stock market, allowing for a quick assessment of its performance. Instead of individually examining thousands of stocks, an index gives an easy way to determine the performance of the stock market on any given day. It was Jack Bogle who in 1970 created the first index fund. This fund were designed to mirror the S&P 500 index, an index that is followed and recognized all over the world. By simply purchasing the same stock and in same proportion as they are in an S&P 500 index, the index fund could keep its cost very, very low. For example, the Vanguard S&P 500 index fund charges an annual fee of just 0.04%. So the index fund and mutual funds sound similar. What really is the difference? So look at it this way. Index funds fall under the category of mutual funds, but not all mutual funds are index funds. The distinction lies in their investment approach. An index fund explicitly says that it follows a particular index, and it will tell you which one. For instance, if you go to Vanguard's website and search for VFIAX, the term index is clearly mentioned in the title. Additionally, the fund's prospectus confirms that its objective is to track the performance of S&P 500 index. On the other hand, mutual funds, which are not index funds, employ an actively managed approach to investments. Their prospectus will state that an advisor will independently select and maintain a portfolio of common stock for the fund. That indicates that a mutual fund relies on an active stock picking by a fund manager rather than passively tracking an index. So again, index funds are a subset or a type of mutual funds that are not actively managed. Instead, they track an index. Okay, I think I now get the difference between mutual fund and index fund. But now what are these ETFs? Okay, so now let's dive into the world of ETFs or exchange traded funds. These fascinating creatures made their debut about 15 years after the birth of the first index funds. And they bear quite a resemblance. But hold your horses, there is one key difference that differentiates ETFs from their index fund cousins: their tradability. See, index funds or mutual funds typically have once a day trading rule. Their prices are determined at the end of the day and you can buy and sell at that price. But unlike them, the ETFs bring the party to your fingertips. You can buy and sell an ETF share at any time when the stock market is open. Yes, you heard it right. They may not be actual stocks, but you can dance with the ETF stocks on the stock market floor all day. Imagine, you are longing to invest in the S&P 500. What are your options? You can either choose an index fund from Vanguard like the VFIAX or an ETF like the SPY SPDR 500. It's decision time, folks. Do you crave the near 24/7 tradability of the ETF, or are you comfortable with the reliable embrace of an index fund? Your decision. While an ETF's on-demand trading features may sound very enticing, it's time to face the reality. Watching those ETF prices rise and fall every minute on the stock chart can tickle the gambling side of the human nature. But let's be real. Smart investing and impulsive buying and selling, which is almost like gambling, they don't go hand in hand. Agreed? So in my humble opinion, ETFs can do more harm than good to an average investor. Why even invite temptation to your financial party? And this is the precise reason why index fund can get on the stage and take an standing ovation from us. Get ready for automatic reinvestments, friends. This is the reason that I myself switched my gears from ETFs to index funds. So picture this. You just set up an automatic recurring deposit into index funds from your checking accounts, and voila, index fund will go to work for you. Effortlessly, every month more and more shares will be bought for you. And best of all, there's no extra charge typically for buying in a low-cost index fund. It's like making investing a no-brainer by putting your good habits on autopilot. Considering the cheeky pitfalls and potential temptation of ETFs, I would say go for the safe and reliable world of index funds. Unless you have a burning desire for ETFs round-the-clock tradability, index funds have your back with automatic reinvestments and simpler, stress-free investing. So let's keep it smart, folks, and let the index funds bring harmony to your financial symphony. So now that we have waltzed through the exciting world of mutual fund, index funds, and ETFs, here is a quick recap to help you remember the differences. Mutual funds were like the cool kids who arrived first, introducing the concept of pooled money for investment. Then came along index funds, the rebels of the group, with their lower fees and the management style that says, let's go with the flow, man. They called it passive management because chilling out wasn't a cool enough term then. But wait, there is more. In a dramatic twist, the ETFs make their entry. They look very much like stocks. They are dressed up like stocks, offering 24/7 tradability. They are like index funds' cheeky cousin who forgot their manners but still get the job done. I hope you enjoyed this topic and now have clarity on what these three types of funds are. If you have any questions or comment, please put them below this video. And if you have suggestion for any future video topics, let me know that as well. Don't forget to like the video and subscribe to the channel. See you next time.